Good morning, everyone. Welcome to our webinar session for the morning. We are joined by Willie Roos, the CEO of Stratafin, and Monique van Beek from PKF Octagon Auditors. So we'll begin. Our topic for the day is auditing requirements in community schemes. And I'm just going to quickly introduce Monique. Sorry.
Thank you, Lauren. Okay, Lauren. So, I'm a qualified auditor. I've basically been with PKF Octagon for the last 15 years. I've done my articles. I've recently, like I said earlier on, had become quite, how can I say it, attracted to the community scheme environment. And currently, my partner and I, we are specializing in this environment. We've recently also been doing a lot of homeowners associations audits, and we've also now had quite a lot of experience in the body corporate audits. So from that perspective, this is why I'm here today. Hopefully I can at least plant the seed, give you guys a bit of indication as to what's involved into an audit, and just also maybe introduction to PKF Octagon.
Super. So we're going to, just before we start the session, we're just going to put up a poll. We'll leave it there for a minute and then we'll share the poll results with everyone. Okay, great. So you should see the results in a few seconds. All right, so we've got 35% managing agents, 28% portfolio managers, 41% trustees, 25% owners, and 3% investors. Lovely. I'm going to leave it to you, Monique, and we look forward to the session.
Thank you, Lauren. Lucy, you can go to the next slide for me. And just on behalf of Alistair, my partner, who was he actually wanted to be here today. He can't make it because of a personal emergency, but he did say that I must please excuse on his behalf. Okay, so now let's try and make a very boring topic, very important topic, quite exciting for you guys. So I'm going to bring two perspectives into mind here, first from the auditing perspective and then from the user of the financial statements perspective. I'm going to try and link the two for you guys. So if we look at annual financial statements today, annual financial statements have to have a statement of financial position. So that's your financial performance. That's where you have your assets, your liabilities, and your reserves. That's what you see on the face. Then you have to have your statement of comprehensive income and expenditures. So obviously that talks about our financial performance, and this is where we're seeing our profits for the year. Our statement of changes in funds and reserves, that's basically just to show what is the position. You can basically call it the net asset position of the company or the entity, the body's corporate in this instance, and then the statement of cash flows, and then obviously the accounting policies and notes. So if you basically don't have these items on your financial statements, technically you're not looking at a full set of financial statements, and there might be information missing from your financial statements that could be key to making decisions. So hopefully everyone has been seeing these items of financial statements and have been presenting these to the members of the entities. Just if we look at these ones specifically, just maybe a highlight on a statement of cash flows. So if we, for instance, look at your cash flow, what your cash flow represents is what is in your bank at that point in time. So at the very end, we are basically going to see what is the net cash and my cash and cash equivalents as at year end. Obviously, the movement in the cash flow represents basically what was paid out and what was received in the various line items. Okay, so if there's any questions with regards to these items, can I please ask that it's either placed into the chat or that we'll share our emails later on, and then you can maybe send us an email and we'll happily address these questions. With regards to the preparation of financial statements, so what we've seen in our experience so far is that a lot of there's actually, not everyone knows, but in terms of the Act, we can basically use as a it's called a user-defined policy that you can use, or special purpose financial statements. But we are seeing that a lot of people are using IFRS for SMEs. So it's not wrong. IFRS for SMEs it's very understandable. A lot of what I'm seeing currently is that a lot of the trustees are preparing the financial statements in terms of IFRS for SMEs. It is a more understandable accounting framework for the general user. However, when we talk about a user-defined accounting policy, we are looking at an entity-specific accounting policy. So for a body's corporate, for instance, we'll talk more about the levies, we'll talk more about the expenditures of the different communal properties, and we'll then obviously talk about our debtors and our levies and received in advance, and we'll have specific accounting policies relating to those items. However, with IFRS or SMEs, it's easier because there's already accounting standards, and I'm saying specifically because I'm going to talk about auditing standards a bit later on. So accounting standards are specified, the IFRS for SMEs are specifying accounting standards for us. So, but once again, just to say that in terms of the sectional title Management Scheme Act, you can basically use a user-defined accounting policy. So there's not actually a specific requirement to say that you have to use IFRS for SMEs or you have to use IFRS, just to put it out there. But now, for me as an auditor, I basically have to look at those financial statements in terms of the auditing standards. So irrespective of what framework has been used, what basis has been applied, I have to use the auditing standards. These auditing standards are very specific, and to put it bluntly, it's putting me in a box, because if you read those standards, it's basically telling you the auditor shall. It's not saying that you may elect. So the auditor shall, for instance, understand obtain an understanding of the control environment, those charged with governance, and all those. There's quite a lot. So we can't just, I can't just go look at financial statements and put my signature on there and be a happy girl. It has to have certain guidelines that I have to audit in terms. Okay. So then, just with regards to audit opinions, what you're basically currently seeing, I'm sure most of the time, is an unqualified audit opinion. An unqualified audit opinion is a clean audit opinion. So that means you're good to go. Me as an auditor, in terms of what's required of me, in terms of the Auditing Professions Act, and in terms of obtaining appropriate audit evidence for the risks that I've identified, I'm very happy to put my signature on that audit report. However, the next three items, so the adverse opinion, the disclaimer of opinion, and emphasis of matter. Hopefully, none of the body corporates that's on this board has ever seen an adverse opinion or a disclaimer of opinion. So these two items, that's where I'm basically saying that there's a material misstatement, and it's material and pervasive basically for the users of the financial statements. So what it basically means is don't rely on these financial statements, because in terms of me, I weren't able to obtain either appropriate audit evidence, or there's such a material concern that I have to bring it to your attention and that I can't express an opinion on that. An emphasis of matter, that's just where we draw the user's attention to something in the financial statements. So what we basically, a very good example is, for instance, if the financial statements are not prepared in terms of a going concern basis, it is prepared in terms of a going concern basis, and it's correctly noted in the director's report and notes to financial statement.
Monique, can I quickly jump in here? I luckily got back onto the Wi-Fi for some or other reason. I lost my Wi-Fi connection, but luckily I'm back again. So before the webinar started, we were talking about once the audit has been done and you have now prepared your opinions and so forth. And the question then arises, who signs this off? Because the financials are drawn up in respect of a particular board of trustees. That is then presented in AGM, and the owners then accept the financials. And then the question arises, who is now going to sign it off? Are the previous board going to sign it off, or is the new board going to sign it off? Can you maybe elaborate on that a bit?
So the new board will have to sign it off. So it's exactly the same principles as with the Companies Act. Once that director resigns and it's before year end, that person is not going to sign off those financial statements. So the same principle applies with trustees then. The new trustees, unfortunately, are going to sign off those financial statements and take the responsibility.
However, they do so because the owners have accepted the financials as proper. So
Yes.
At the end of the day, there's no risk for those new directors once they sign it off, because it was presented to owners, and owners at the AGM then accepted the financials. So there's no burden on the trustees once they sign it off then.
Yes, so I'm addressing it later on in the slide, but like you said, so the financial statements are presented to the members and obviously then authorized by the trustees of the board.
Sorry, I jumped in there.
No problem. Thanks, Willie. Okay, so if there's any questions on the slide, you're more than welcome to pop anything into the chat or to send us an email. We'll share our contact details at the end of the presentation. Thank you, Busy. You can go to the next one. Okay, so the purpose of this slide, basically, what we are trying to do is just reiterate and say whose responsibility, and it is, for instance, if we just look at the going concern, and what is the responsibility of the trustees here? So, because what we've seen is that trustees don't really realize, firstly, what a going concern is, and secondly, what is their responsibility towards a going concern. So in short, a going concern is basically, if you look at a set of financial statements, that set of financial statements have to look healthy. So your assets have to increase your liability or have to exceed your liabilities. And in the next foreseeable 12 months, you should be able to pay all your financial obligations and your liabilities, your operating, if I can put it, your working capital should be covered in the next 12 months. You shouldn't be having to go and look for money to run your operations for the next 12 months. So in essence, that's what a going concern is. But now, if we look at the trustees' responsibility or the approval that they sign, each trustee that puts their signature on there actually say that they have assessed the body corporate's going concern for the next 12 months, and that they are satisfied that the body corporate has adequate resources to continue as a going concern. So I'm just emphasizing it because we've seen that trustees actually don't realize that this is their responsibility firstly, and that they should actually be assessing it. So if there's a scenario where there's not enough funds, the trustees actually can go and get extra money through special levies and the requirements in terms of the Act to get extra funds into the entity. Busy, you can go to the next slide. So here on the trustees report, which is also, this is the extract from the financial statements, the trustees once again are saying that these financial statements have been prepared as a going concern. So if there's an instance where the financial statements is not a going concern, the financial statements are prepared on a liquidation basis. So that means that body's corporate is in essence not actually going to operate in the foreseeable future. That's what it means. So that's why it's very important to make sure that when the trustees are preparing these financial statements, that they present a going concern. And it's our responsibility as auditors to actually assess it. So that's why I've put it in here, so that the trustees are very aware that if they put their signature on it, they know what it is and they've assessed it, and they are happy that these financial statements are prepared as a going concern. Just to bring in the emphasis of matter paragraph here, if there's an instance where it's let's say for instance there's a liquidity issue, and the trustees are aware and they have gotten some funding or have raised special levies, so they are looking into the foreseeable future to do something about their going concern issue. I, as the auditor, have to bring the users of the financial statements to that point. So I have to say to them, yes, these financial statements were prepared as a going concern, but we have done X, Y, Z to ensure that going forward, these financial statements this body corporate will be a going concern. That's just to bring in the emphasis of matter. So that will be emphasis of matter paragraph in the audit report. Then ultimately, the trustees are approving the financial statements. That was what we were talking about earlier. So they have the understanding and the knowledge of what's happening in the body's corporate. And to your point also, Willie, is that yes, maybe the old trustees were involved in the running of that specific year, and the new trustees might not be. However, the members they are presented to the members at the AGM. You can go to the next slide, Percy.
Can I quickly also just jump in here? Aronstein asks a question on the group and he says, does the chairperson sign off together with the auditor, or should there be a minimum of 2 trustees that sign this off? Now, I know that's not your field of expertise, but what is your view on that?
So for me at this point as an auditor, there have to be authorization. So I'm going to once again refer to the Companies Act. If there's a resolution passed to say that one person are allowed or is allowed to sign off, then yes, I will accept the chairman's. But also, once again, really, it's not my level of expertise, but as an auditor, I'm answering.
Yeah, so I think from a point of view of a body corporate acts through its trustees and do so by way of resolutions, and those resolutions, the access must be signed by two or those documents or any contracts must be signed by 2 trustees or 1 trustee and the managing agent. So I think that would be applicable in respect of the financials as well. I know that when I was still managing schemes, I actually made provision for all the board to sign. So I would ask every member of the board of trustees to actually sign it off.
Yes, yeah, and Willie, we're actually getting a lot of questions as to who needs to sign off and why the members aren't signing off. But like you said, the Act is very specific on who has to sign off. It's not my level of expertise. Alistair is the person that knows the Act backwards. I'm the one that audits, and I'll go and let's say, for instance, I get into a scenario where I have a question, I have to refer to the Act and audit accordingly. And I'll come to those points just to highlight it from an auditor's perspective. But I'm going to continue now. So what we are looking now at is a reasonable assurance definition. So for a lot of people, I'm not sure if this makes sense, but a reasonable assurance, that's basically when I sign off, I have a reasonable assurance that those financial statements in all material aspects represent fairly the financial position and the financial operations of the company or their body's corporate. So in essence, I have to then go and get sufficient appropriate auditor evidence and then conclude on that evidence. But that whole process is so intense that I have to understand to get the evidence, to conclude and to sign off, and then to get reasonable assurance. We've put that this is the definition of reasonable assurance. These slides will be distributed and people can read the definition, but in essence, that's what it means. You can go to the next slide. Thanks, Chrissy. Okay. So what we then do with this reasonable assurance, if I could put it like that, is we apply it to the next 5 points. So we basically go and just also, this is an extract from an audit opinion. These 5 points is the audit in essence. What we are looking at point 1 is the planning phase, that we basically do a risk assessment, we understand the entity. And as I mentioned before, these things are guided, and it's putting me in a box. It's telling me the auditor shall. So I shall go and obtain an understanding of the control environment. I shall go and obtain an understanding of the material risk of a statement. And I then have to go and assess it and, develop or design audit procedures to respond to these risks. So that's the very first step I do. So what it means is that I'm assessing my risks. I am now going to perform my audit procedures to address those risks, and I'm then going to conclude. That's point number 1. So just to talk about time, if we just think about this process, it's not this process is not a day. This process is minimum 3 to 5 days for a engagement that it's a small engagement that you've done before. So we are going to get to it later on, but it's not a day's job or hour's job. This is something where you have to put your mind to it. You have to understand what you're doing so that you can develop your audit procedures and so that you can conclude based on the evidence you've obtained. The very next point, we are basically going to evaluate the appropriateness of how can I put it, the accounting policies that's been applied to the entity. So if we look at a special, or let's use it a user-defined basis of preparation, I have to go and evaluate whether that talks to the entity. So where with the IFRS for SMEs, I've got guidelines and it's easier to assess, but with a user-defined basis, it's a bit different, and I'll have to use a lot of professional skepticism to get to a conclusion here. I'm trying to think of an example in the body's corporate here, but let's say, for instance, because the accounting estimate here talks to, for instance, depreciation. So let's say, for instance, you've got a rental unit that's common property that you're renting out and you're getting income from it and you're depreciating that rental unit. I have to go and assess whether the depreciation that you're using, so your estimate there, is it reasonable and does it really talk to what the body corporate operations are? Okay, so the next point, we are basically we are concluding on whether the basis of preparation is correct here. So once again, whether it's the specific use or whether it's IFRS for SMEs. Then we are concluding on the presentation of the financial statement. So how does it look as a whole? Does it really talk to the operations of the body's corporate? And then lastly, we have to communicate to the trustees and those charged with governance what has been going wrong in this audit, if there was any deficiencies in internal control, any deficiencies that we have to bring to the trustees' attention. You can go to the next slide. Thanks, Pussy. So those 5 points that I've highlighted before, just to bring your attention to it, you'll see that there's a lot of instances where we are saying, have the trustees done the correct thing? So we are definitely looking to see what the trustees are doing. Is it in terms of the act? Does it really have the operations of the body corporate at heart? And we basically conclude on that also. I just want to throw it in there because in the next slide, the audit of a body's corporate is more a compliance audit than a fair presentation audit. And to talk about a compliance audit is that where we have to audit in terms of the law. So we are told here, you can see in terms of this regulation, that we have to look at the regulation 21, 24, 26, for instance, and we have to go and audit that those specific items have been or were done during the course of the year. So just to look at these various items, for instance, the loans that were given, were there special resolutions? And a compliance audit is a tick box approach. So we'll tick, yes, there was a special resolution, or tick, no loans were made. Then we'll go and see, were there any levies refunded? Tick, yes or no. And so we'll go. Just to come to a point, let's say there's a no. Let's say, for instance, there's no special resolution. That, in essence, is a non-compliance. So we have to make the user of the financial statement aware that there's a non-compliance in terms of this regulation. And that's where you'll see, I don't know if any of your financial statements has had it, but there will be these special notes to say non-compliance with this regulation in terms of this rule. So we basically go through all of these items. Like I said, a tick box approach. We go and make sure that no profits were distributed to any members other than whether it was capital profits or if there was a demolition or a destruction or whatever in terms of a building. We'll go look at the funds that were deposited. Was it in an interest-bearing account that's in the name of the trust or in the name of the body's corporate? We'll go and see whether any special levies raised, was the correct process followed, and so forth. I'm not going to go through each of these points, but these are basically things that we look at. Like I said, it's a tick box approach. Non-compliance will trigger a note or a reference on the auditor's report. You can go to the next one. Thanks. So, Regulation 24. This is one of the regulations that I've seen the most mentioned on the audit reports before. So there's still a lot of bodies corporates that doesn't have the proper, for instance, maintenance, repair reserve fund or administrative fund processes in place. We go and we check it. So there's definitely a guideline that we can use. We recalculate it, but I have to emphasize we are not experts here. So we can't go in and say that a roof, for instance, needs to be painted within the next 10 years, and we have to go and repair the pool every 5 years, for instance. That's not our level of expertise. That's the responsibility of the trustees. If they don't have that level of expertise, it's definitely recommended that they get someone involved to make sure that those items are properly looked after and that the bodies corporate have the correct reserve in place there. So just with regards to the specific rules for a reserve, we'll go and make sure that the funds that's transferred in and out of these reserves does meet the requirements of the Act. We've put them down there. I'm not going to go through all of them. I'm not seeing anything that I want to highlight here. You can go to the next slide. Thank you. Okay, so Regulation 26. This is also the regulation that basically says that the financial statements doesn't need to be prepared in terms of IFRS or IFRS for SMEs, where we can use a user-defined accounting. We can prepare the financial statements on a user-defined basis. But what we have to do here in terms of this regulation is basically go and check once again all of these items. So we have to make sure that there's proper books, that there's proper sub-ledgers, debtors and creditors, that the reserve funds are kept into separate bank accounts, that they are maintained separately, that the financial statements are prepared in terms of those prescribed rules. So those rules that we are referring to, the 26.1c, 1 to, I think that's number 6, that basically has certain guidance as to what we need to do with debtors, what we need to do with our reserves, what we need to do with our levies. And we have to go and make sure that those specific requirements are met. And once again, like I said, it's a tick box approach. So we'll go and say, yes, it's been met, or no, it's not been met. Is the maintenance reserve in the prescribed format? Is there a proper budget presented at the AGM? Is there a trustees report presented at the AGM? Is the AGM within the next 4 months of the body corporate hearings? So these are the things that we check. Once again, if there's any non-compliance, we bring it to the users of the financial statements' attention. Thank you.
Can I just jump in there quickly? So something that is very or a debatable, or not a debatable point, but a point of contention on sectional title living South Africa, we see a lot where people are saying, but we did not do the audit within the 4-month period. Or we did not comply with A, B, and C. And what is the sanction of that? So now you've looked at this and there was non-compliance with that, and you make the note on the financials. But at the moment, we don't see any sanction by CISOS where there is non-compliance in that regard. So I would think that the only penalty is that owners are now aware that things were not done correctly. And that then gives owners the responsibility to ensure that they pick the right trustees that are compliant, until such a time as we have a regulator with teeth that says, if you've not done so, then we can fine. But the problem is then you find the owners, and they are not responsible for that. It's the trustees that are run the body corporate on a day-to-day basis, but in accordance with the budget that they have approved, but at the end it is not owners. So if you must find the body corporate, it will actually hurt everybody. So I don't know how that is going to resolve. I mean, you guys note it in your financials, but it just stops there.
Yes, so just with regards to this point here, that the financial statements have been prepared and prescribed in terms of the formats specified in 26.1. So there's actually a note to say amounts due and payable to the Community Scheme Ombud Service. So that's the only reference so far where I, as the auditor, can no, actually there's a few other aspects, but let's say, for instance, there's an issue where the money is not paid over to the ombud or charged to the members. That's actually a material breach to laws and regulations, and I then have to most likely raise a reportable irregularity. So that's a word I think for the auditor and for the user of the financial statement, you don't really want to hear. But we are then making CISOs aware that there's non-compliance, and then I've read recently that CISOs is going to be looking at, for instance, or be talking to URBA to see for any non-compliance. So I think it is in the works where it is going to come through, where CSOs and URBA will be talking, and reportable irregularities will be attended to. But there's no guidance as to what the penalties and the implication on the body's corporate is at this point in time. But if I can maybe just open up something for me that I maybe just want to talk about. If there's, for instance, an instance where there's a material breach, or there's an issue that is resulting in a material misstatement, or there's fraud that I've picked up, for instance, I have, as the auditor, have to assess if there's a reportable irregularity that I have to report. So in a normal company, for instance, you'll either report it to SARS if there's, for instance, non-compliance, or you'll report it to CIPC. In this instance, I think we are going to go towards CSOs to report the reportable irregularities to CSOs. If not to CSOs, we'll report it to URBA, and URBA will have to make way with it. But
if there's fraud, should that not be reported by the auditor then maybe to the police, because then there's a consequence to that report?
Yeah, so that I think fraud is a different instance, so that will be reported to police but also to URBA. So the moment, unfortunately, but our reporting line is URBA. So we have to, the moment that we see there's non-compliance, we report it to URBA and to CSOs, for instance, or URBA and the police. So those will be our reporting lines. URBA is the one that acts, if I can put it like that. So that's why CSOs and URBA should be talking. Okay, thank you, Lucy. Okay, so this is, as I've specifically put this this paragraph in, we've gotten a lot of kickback on this, where people are saying, how can you not express an opinion where you are required to express an opinion? So SAICA got involved, CSOs got involved, and they've basically concluded that we cannot express an opinion on these two items. And I'll explain it as best possible as I can. But what they want from us here is basically to say whether the body corporate's books have been kept and its funds have been managed to provide a reasonable level of protection. So the question here is, reasonable level of protection is not measurable. If you think about it, we have, for instance, let's say 2,000 practicing RAs in the country. Each and every one will go and measure reasonable level of protection separately. So there's no guidance in the Act to say to me, for instance, a reasonable level of protection. I will go and, for instance, there must be, let's say the funds must be kept in a certain type of account. There must be 3 authorizations for the money to move from the one account to the other account. Trustees have to be involved, for instance, in a transfer. There must be 3 quotations. So there's no guideline for me as an auditor to go and measure as to what does reasonable level of protection look like. So I cannot, like I said, this is a compliance audit, so I cannot go and have a tick box approach here to say, yes, we've got 3 authorizations. Yes. So sadly, this is what it boils down to. I cannot measure this specific. I cannot tell you as an auditor that the funds have been managed at a reasonable level of protection against theft and fraud. So I cannot do it. The same with the next question, or the next one, that the financial affairs of the body corporate appear to be effectively managed as required by the rules. So effectively managed, once again, it is not, there's no guidance to tell me that effectively managed, this is how I'm going to measure it. So for instance, is there a type of GL format that they require? Is there, for instance, once again, let's talk about the authorities. Certain people had to authorize. There's no tick box approach where I can say, yes, this has been done, yes, that has been done, or no. So that's why SAICA and then CSOs have concluded that we cannot express a opinion or a conclusion on either of these two items. For the sake of the people that want to read, the next slide, Lucy, please. So this is basically extract from SAICA's how they've approached it, and also the next slide. So this is basically how they looked at it to say why we cannot express an opinion on these two items. So in essence, I truly hope that I've brought some light into our auditing world so that everyone on this board can understand and see what is involved. Why are we saying what we are saying? Why are we asking the questions that we are asking? And then also, when you now read the report, that you are actually able to understand what are we reporting on. And that's my story, really. I think you're on mute.
Sorry. I'm not going to let you get away that easily. I bombed out, and I hope I'm not going to bomb out again. But yeah, so I think we've touched on auditors and the auditing of the scheme, but we did not touch on the size of schemes that require auditing. I think from the industry's point of view, the cost involved in an audit, because we can now see what you guys need to do, is astronomical. And if you've got a scheme that are 5 units or 10 units or 20 units, then that audit would cost more or less the same as an audit for a scheme of 100 or 200 or 300 units, because you're doing the same exact work for the small scheme that you do for the larger scheme as well. So the previous legislation talked about an accounting officer. So would you not think that that is a better way of dealing with it, where you in the smaller schemes just get an accounting officer that then states that the financials have been done properly, and that all the requirements are met that you've discussed now?
Absolutely. Now, for me also as an auditor, I mean, if you just think about the logic around it, if there's, let's say, 3 to 10 units, they probably know each other so well. And to go and perform an audit on a scheme that size, I don't really think it adds value. I think it's more a compliance matter. So I'll definitely say for a smaller scheme to either have a compilation done or an independent review done rather than an audit. The independent review is also an analytical approach. So the auditor or the person performing the independent review will look at it from an analytical point of view, and they will also inquire and then conclude basically on the financial statements, where the compilation is more just putting the financial statements together, checking the balances, and doing a accounting officer report.
Yeah, so as the accounting profession, are you guys taking that up with the legislator? Yes. I mean, there are talks about the Sectional Title Schemes Management Act now being amended again. And maybe that is something from the audit profession that you can indicate that is a very stringent requirement that actually places a hardship on smaller schemes.
Yes, yeah, no, we definitely are going to the right people at this point, and hopefully in the next foreseeable future, we'll see a change in legislation. And like I said earlier on, when I spoke to you prior to this call, if we could get it done for even up until, let's say, 30 or 20 units, I think that's ideal. Everything over and above that, get an audit done, get some assurance on that engagement. But anything lower than that, at this point in time, I truly don't think that we can add value to the community scheme.
Okay, that's wonderful news if you guys will do that. I mean, I think from industry side, we are also pushing for that, and we are asking for CSOs to look at that when they present their amendments of the scheme of the Sectional Title Schemes Management Act. So that would be wonderful if you guys could also push from your side, and that will help schemes. Then regarding your first slide, where you also in your composition, you also have your cash flow statements. So I've said it many times in webinars that I've done. I see body corporates a budget for income and not for cash flow. And what I mean by that is you've got you budget because you require R1 million for the year to pay all the expenses. So you budget for the R1 million, you apportion that to the owners in accordance with their PQs. But at the end of the day, 30% of owners are not paying. And now you're only recovering 700,000 Rand. So from that point of view, I would think that it's important that one must look at the cash flow statement. That is actually even more important.
Yes.
What is your view on that?
So I think there's a few ways to approach this question or to answer this question. Firstly, the cash flow at that point in time represents the money that is in the bank. So in that cash flow, hopefully, is in excess of what the operations on a monthly basis is. So let's say, for instance, to maintain the operations of the body's corporate, let's say you need like 500,000. Hopefully, that bank balance is in excess. So hopefully, there's excess money for you to go and divide the excess. However, I also want to say that if your financial position, so that's where we go back to our going concern. If your financial position is not positive, let's say you just have a positive bank account, I think it's something that you have to carefully consider before you do anything. That balance, especially if we talk about the cash flow balance, is what it's not. You can't see it as a profit, if I can put it like that. It's what's in your bank, and hopefully, I'm not sure if this is answering your question really, but hopefully that is an excess.
Yeah, so I just believe that a body corporate must look at the cash flow statements and must understand that they've got a non-compliance of, say, 30%. And unfortunately, what that will do is they will have to increase the levies to make sure that there's sufficient income from a cash flow point of view that they can pay their expenses. Otherwise, that scheme will become dysfunctional.
Exactly.
So it is definitely something that schemes must start doing. I've never seen that. Maybe there are schemes that are doing that, but that is how they should look at it from a cash flow point of view.
Exactly. And like I said, from an auditor's perspective, we're reassessing the going concern. It's exactly boiling down to what you were saying.
Correct. Then let's deal with those debtors. Now we have 30% of the people that are not paying. In the audit, should that be stated as one of the notes that these are the debtors, this is the people that are outstanding, so that all owners are aware who they are. And now we're going to get to the poppy argument. Can we then disclose that?
Well, the specific requirement here is to say that they must be mentioned. I must just find it quickly. Classified by member and the periods for which such amounts were owed. So by member, so what we're currently doing is we're just showing the unit number. We're not showing who's the person. But I'm sure that whoever is staying in the body's corporate will know who's staying in unit number 5. But in terms of this legislation, you have to classify it by member and for what period it's outstanding. So to talk about the POPI involvement, so I'm not an expert on the POPI Act. So I can just think, because I've had for instance, questions where we have to disclose in terms of the Companies Act, we have to disclose the directors' emoluments. And I've had directors challenging it based on the company, based on the POPI. But according to us, the Companies Act overruled the POPI Act. You have to disclose the directors' emoluments. So I'm not sure if that approach can be applied here, but for us, a getaway point, and I shouldn't say it's a getaway point, but to meet the requirements of the Act, we show it per unit number and then the amounts that's outstanding.
Yeah, I also think that once you buy into a scheme and you understand how the legislation work, you are then obligated to follow that legislation. So if the requirement is that it must be disclosed, then you must just take that, because you bought into a scheme knowing that that is the requirement, and you also know that you must pay levies. So at the end of the day, pay the levies and your name won't be there. So,
yes, exactly.
Yeah. Then just to come back, our point, the discussion that we had about the accounting officer. So that is not the legislation. The legislation is that that it has to be audited. What we are saying is we must go back to the old legislation where you could use an accounting officer, because it's onerous for smaller schemes to actually go the full audit process.
Yes, no, absolutely, I agree.
I just saw in the questions there was a bit of a confusion there. I think people thought we're saying that is how it is, but it's not. We're saying that's how it should be again.
Yeah, that's how it should be. Hopefully going forward, but at today's date, no, everyone has to be audited.
Okay, then one of the things that you also check is the redistribution of funding or levies paid. So I've had this discussion on sectional title living with people there, where a body corporate would budget for a deficit. So they understand that the amount that they levy is less than what they need for the year, and they have a surplus. So they're saying, well, we're now going to budget for that shortfall. And in my opinion, that is a distribution of the funds of the body corporate. You are now distributing money back to the body corporate. So you could never, in my opinion, budget for a deficit. You must budget to pay all your expenses. If there's a surplus, you then put that over to the reserve fund or whatever you decide how you're going to deal with that. But you can't budget to actually then distribute that surplus back to owners, because that's what you're doing in essence.
Yeah, I'm in full agreement with you there. I've had similar instances where the body's corporate had sufficient funds, and they were saying, but why can't they use these funds? Like you said, distribute it. It just doesn't make sense, because if someone buys into that unit or buy into that body's corporate scheme, they're gonna have the expectation that is the levy going forward, just in my auditor's mind, But I mean, you guys look at it from a legal perspective, and then let's say all of a sudden it's been taken away, and that levy is then increased to what it should be. I think it's you sort of have to communicate it to your new buyers. But that's just my input, my opinion. But I agree with you.
Yeah, it's my opinion as well. It's nowhere in the law, but I just think that is in essence what you are doing, is you're giving money back to people. Then you also discussed, and I think it is very relevant at the moment now that there was one of the managing agents that has closed down again. The money must be in the bank account in the name of the body corporate or in a trust account. So a trust account in general is that bucket account of the managing agents where all the different schemes money lie in, and then they pay out of that. And the only differentiation, or the only way that you can differentiate whose money is whom, is by looking at your accounting system to see what money you should have in your bank. How is it possible for you as auditors to actually audit that trust account if you're not doing the audit on all the schemes who have money in that trust account. So you might have 10 different auditors doing 3 audits on the scheme. So there's 3 for that, 3 for that. So there's 30 audits or 30 different schemes in that bucket account. How would you ever know that all the money is there?
Okay, so I mean, we do it purely through our audit processes. So first, we have to, at day one, we have to assess that managing agent. So we'll go do some research, understand, see if there's any bad publicity on this managing agent prior to doing anything. Because that's, I mean, if you see something bad about a managing agent, my professional skepticism is already impaired, if I can put it like that. And I'll definitely not rely on anything that managing agent is presenting to me. At that point in time, let's say, for instance, there's no bad publicity, they've been in operations for a while, they have a good reputation. We then go, and our audit procedures are, they're designed to automatically already factor that in. So if you, for instance, think about it, let's say, if we just look at, for instance, a normal attorney's trust, the principle is the moment that money moves out of the trust, there must be supporting documentation. That supporting documentation have to meet certain requirements. So exactly those type of things are the things that we are looking at during our audit procedure. So bear in mind that we audit income, we audit expenses, we audit assets, we audit liability. So all the items basically on the balance on the financial statement, in essence, factors through the trust account. So we'll look at those items.
But you're not auditing all the schemes.
Yes.
So that's where the problem lies, because you don't know what, if there's supporting documents in the other scheme, you don't know if the income in the other schemes are correct. You don't know if the expenditure on the other schemes are correct. So that creates the problem with the trust account.
But somewhere they're going to slip up. Let's say they are being naughty. Somewhere they'll be slipping up, and somewhere they'll be missing a procedure, and somewhere in our procedures we will pick it up. It's not, like we said, it's not absolute assurance that we are giving. So if we are giving absolute assurance on our audit opinion, we are basically saying it's a done deal, everything is fine. We are giving reasonable assurance. So through all our audit procedures, nothing came to our attention that made us think otherwise. So if we perform these audit procedures and we then see something is not right, we will either extend our audit procedures or we will change our audit approach and do something else to get to a reasonable assurance level. I'm not sure if that answers your question, but no, I guarantee you that at the end, when I put my signature on that audit report, I have a reasonable assurance, hopefully. Yes, I cannot detect fraud. In my audit procedures, if I do detect fraud, it's a bonus. If I don't, it's ultimately management's responsibility, or the managing agent or the trustee's responsibility to detect fraud. But at that point in time, I've not detected fraud, I've performed my procedures, I'm quite happy to sign off on the balance as at year end.
Okay, I hear you. My opinion is legislation should be changed and we should have separate accounts for every body corporate.
Yes, no, that would be ideal.
I just think that is the safer way and the safer route for a body corporate to go. I know that managing agents don't like that. I mean, they would rather have a bucket account, but I don't think that is the optimal way for a body corporate to manage its own affairs. You also had a chat about a BC in your reporting, where you were discussing Regulation 24, where you say the BC must have used the money in the admin fund for expenditure in accordance with the trustees' resolution and approved budget. So this also is a difficult one for me always, because what happens where a scheme budgeted for 300,000 Rand for municipal accounts and they budget 600,000 for security, and now we see that the municipal account is 400,000 and not 300,000, and security is not 600 but only 400,000 as well. So there is a bit of a surplus in respect of what you budgeted for your security, but you are using more for municipal services is what you thought. Can the trustees authorize those payments? Can they look at the whole bottom line of this budget, or must they look at that specific line item?
So I'm going to once again answer you from an auditing point of view.
Okay.
I think also maybe just Alistair will also give his input here. From an auditing point of view, strictly in terms of the law, or in terms of this legislation, the budget is the budget, and we are auditing in terms of the budget. So if there's any omissions or any changes or any, let's say, increases or decreases, whatever the case might be, we will go and check, get an understanding, and then see if it's in terms of the legislation. So if there's no special resolution or anything to that nature that authorizes that, as an auditor, I might be raising a concern. But I think for us at this point in time, municipal accounts is a bit of a, you 1 year you see 100,000 and next year 600,000. But if it's let's say anything else like a repair that they should have budgeted for, that they haven't budgeted for, that might raise a concern to me. And I think the act will have to be applied at this point in time. And then also I will have to make the user of the financial statement aware that you have a budgeted 400,000 and you've used 600,000. You didn't follow the act, and it's most likely breaching the law.
Thanks, Monique. Thank you so much. Thanks for sharing your expertise with us today. Just before we go off, I see we are a minute or two late already, but we're going to cut this now. But there was just one other aspect that came out of the questions, but we will answer all the questions at the end. We'll ask you to assist us with that from your point of view and from an auditor's point of view. But where the Sectional Title Schemes Management Act is silent and it does not tell us what exactly needs to be done, one would then look at the Companies Act to see what does the Companies Act require under those circumstances. So we're not saying, when you say in terms of the Companies Act, directors should A, B, C, and D, it's because the Sectional Title Schemes Management Act is silent and you're now looking for the best alternative to actually get that assurance and make sure that things are right. Am I understanding you correctly in that regard?
Yeah, Companies Act, any common law in this instance would then assist us with our auditing. Correct.
Thank you so much, Monique. Really interesting stuff. We really appreciate it, guys. PKF Octagon, auditors, speak to Monique and let them assist you with your audits. Thank you so much, everybody.
Thank you.
Really appreciate it.
Thank you, Willie. Thank you for Stratafin as well.
Thanks, guys.
Bye-bye.